All right, today we're going to take a look at the latest half-year report from Miyoshi Limited. And at first glance, it's a real head-scratcher. The numbers seem to be telling two completely different stories, which, for an investor, can be pretty confusing. So let's dive in and see if we can piece this puzzle together.
And here is that puzzle right up front. Take a look at this. The company's revenue, it dropped by nearly 10%. Yeah, not what you want to see. But then look at the other side. Their financial loss shrank by a whopping 65%. So how does that even work? They're making fewer sales, but they're losing way less money.
And that really brings us to the million-dollar question for anyone looking at this company. What are we supposed to make of these numbers? Is Miyoshi finally turning a corner and getting healthy? Or is that drop in sales a huge red flag we can't ignore? Well, that's exactly what we're here to figure out.
Okay, so first things first, let's tackle how a company pulls off shrinking its losses so much. The answer, really, it comes down to one word: efficiency. It looks like Miyoshi got very serious about tightening its belt.
When you look at the breakdown, you can see exactly how they did it. The savings are pretty impressive, and they're happening all over the place. The cost of their raw materials went down by almost 13%. Now, that's more than their drop in revenue, which is a really key sign of good management. They also managed to cut other expenses by over 14% and even got their finance costs down. This wasn't just one lucky break. They were trimming the fat everywhere they could.
So the crucial point here is that this was a deliberate strategy to become a leaner operation. For every single dollar of sales they brought in, they spent less on materials, on overhead, and on interest than they did before. And that, right there, is how you shrink a loss.
So that efficiency story is pretty clear, and it's good news. But we still have to talk about that nearly 10% drop in revenue. We can't just sweep that under the rug. So where did those sales actually disappear from? Let's take a look. This slide tells a really interesting story when you look at it by country. The biggest hit, by far, came from the Philippines, a $1.6 million drop. Hungary and some other markets also fell off a bit. But then you've got China, which actually grew by $1 million. Now that growth is important. It helps soften the blow from the other losses, and it really signals a shift in where their business is coming from.
Now, profit and loss statements are one thing, but any seasoned investor knows you always have to follow the cash. The cash flow statement is like the ultimate reality check. It shows us how money is actually moving in and out of the business. And this is where the picture gets a little more complicated.
Let's break this down into 3 simple steps. First, you've got operations. Think of this as their main day-to-day business. They brought in about $647,000 in cash, which is good, but it's a lot less than they brought in last year. Second, investing. You can think of this like a side hustle. They sold off some assets, which gave them a nice $1.3 million cash injection. And finally, financing. This is about managing debt, and here they spent a big chunk, over $4 million, mostly to pay back their bank loans.
So, when you add up the cash that came in and the cash that went out, you get this number. Despite that much smaller loss on paper, the company's actual cash in the bank went down by just over $2 million during this period.
So the big takeaway here is pretty clear. Selling off those assets definitely helped. It provided some much-needed cash. But the company's core business just wasn't generating enough money on its own to cover those huge loan repayments. That's a really crucial detail you just wouldn't see on the main income statement.
So what does the company itself think about all this? What's their outlook on the future? Well, let's take a look at what they're saying, where they lay out both the challenges they're seeing and the strategy they're planning to use.
This direct quote from their report pretty much says it all. The leadership is not declaring victory here. They're bracing for a tough year ahead, and they're using that word cautious to make sure investors know it too.
And here's a look at what's keeping them up at night. They're watching things like trade tariffs from the US, the ongoing conflicts in Europe and the Middle East, plus the simple fact that the cost of doing business is just going up for everybody. These are big global problems that are pretty much out of their control.
So what's their game plan to deal with all this? Well, it seems like they're sticking to what has started to work for them. They're going to keep their focus squarely on their main engineering business, keep that tight grip on costs, and just continue to push to be more and more efficient. It's a classic defensive strategy for uncertain times.
So after digging through the profits, the sales, the cash, and the company's own outlook, what should an investor really take away from all this? Let's try to bring it all together.
This, right here, is the ultimate question. Miyoshi has absolutely proven it can get leaner and more efficient, and that's a huge step toward being profitable. But
It did all of that while its sales were shrinking and its cash reserves were going down. The entire story now really hinges on whether this new, smaller, more disciplined version of the company has what it takes to navigate all those global challenges it sees coming and maybe, just maybe, find a way back to real growth.
This content is intended to serve strictly and only as an informational, independent, objective summary of recent events, and should in no way be interpreted, construed, or relied upon by any party as inside information or financial advice.